Start. This is the second lecture with some empirical stuff in it, and hopefully your last with other folks coming in with highbrow theory soon. So this is so you know the title of this presentation is it was political economy of financial regulation, and I made it about political economy of decentralization. Okay, and I'm going to be talking about again some evidence on decentralization. But so there's a very large literature on trade-offs between centralization and decentralization. Going back in public economics, you have this famous decentralization theorem, Due-Oates. Okay. Talking about why it makes sense to decentralize decision making. The idea being that decentralize in the absence of, say, externalities or spillover, decentralization seems to be the best thing to do, because you can then cater to local tastes and have policies that can then target local tastes, and that could be better than a centralized structure which is a bit more rule based, or trying to is less responsive to local needs. Okay, so I'm going to talk about some trends because this is on bank regulation or financial regulation. But if you look at banking supervision in Europe, there is a trend towards these what are called supranational bodies. So supervision is shifting towards more is getting more and more centralized. Okay, so you have what is called single supervisory mechanism, you have a single resolution mechanism, there's a European-wide deposit insurance scheme, right? And if you look at the arguments behind this, the argument is that proponents argue that there are increasing interdependencies between various European economies, and by shifting the decision making to a more centralized body, a supranational institution, they can actually take into account these externalities that are created, and that can generate a better result. There are, however, concerns that centralization takes away control or decision making away from the national supervisors, and the centralized bodies, the supranational institutions, might not act in the best interests of a particular country as national supervisors might do, especially in cases where the supranational institution is probably more prone to listening to, say, Germany or France as opposed to a smaller country like Greece, right? So the question is, how do you talk about it? Now, in contrast, if you look at various policies in developing countries, right, there is a trend towards decentralizing decision making, and somehow there's this approach that decentralizing reduces corruption. Okay. Now, as I said earlier, there's a big literature on this, not just in public economics, all right, but also in organizational economics, trying to understand the trade-offs between centralization and decentralization. So for those who've looked at a bit of organizational economics literature, there's for example, a paper by Aghion and Tirole called Formal and Real Authority in Organizations, right? That sort of comes up with some sort of similar trade-offs, which is if you decentralize decision making, you give the agent more initiative, and that can be a good thing. The problem happens is that it also opens up to too much of discretion can be a bad thing, because then the agent might lend to friends, etc., or what he calls private benefits in their model. Okay, so there is some sort of a congruence parameter, which is when the interests seem to be aligned between the principal and the agent, you actually decentralize decision making and things like that. Now, in the case of supervision, there are some papers that have looked at what happens when you shift supervision from a national level to a more centralized structure. Okay, so there's a paper in the US, for example, that looks at, so there's a rotation scheme for banks in US, where sometimes the state, so there's a rotation scheme every year. I think it changes, and there's a QJ paper which looks at what happens to the Camel ratings. Camel ratings is some sort of a rating that is given to the banks, which is again a measure of banks' health, etc. Okay, they look at how these rating changes when the supervisor shifts. And what they find is a consistent pattern that whenever the federal supervisor comes in, which is a more centralized supervisor, the federal supervisor tends to be much tougher than the local supervisor. Now, while this, it's an interesting result, it begs the question as to what drives this. Why is the federal supervisor tougher? And it also asks this question: who gets it right? Right? Is it just being tough, or or something else? So there's that effect as well. There are also papers that have looked at European-wide, banks regulation moving to the ECB. So big banks being supervised by the supranational ECB, and they find that these capital charges we were discussing in the first lecture, right? The capital charges under the ECB regime tend to be much higher. That means the same PDs that we were discussing in the first part of the lecture, they tend to have a higher PDs, and therefore higher risk weights. All right. Now it does create a problem, which is these banks with higher risk weights then lend less. So there is that drawback that under ECB supervision, banks tend to have higher PDs, therefore higher risk weights, and they tend to less well. Okay. So there is always this trade-off in mind, which is you can be tough, but then it can constrain lending, has implications on growth. So what I'm going to look at is this question with a little bit of more micro evidence, and it'll come out from bank bailouts, and trying to understand what are the different forces in mind. And I'm talking about supervision out here, but you could think about Brexit as a move towards more decentralized decision making, right? Whatever your views on Brexit are, I'm not going to get into this. In UK, it already gets too much to handle. But if this is from Boris Johnson. This is a time when the voting was going through. But the idea was we're going to take back democratic control. The fact that this European-wide control is shifting to European Union, right? And what we're going to look at, what I'm going to show you some evidence is, are there some political economy considerations of this decentralization? What does it mean having control? And this will come from a slightly different setup. So I've already said about set of papers that have looked at supervisory authorities, whether they're centralized or decentralized, and they all seem to find this consistent pattern that centralized supervisor tends to be tough. There's some who've also looked at how does a centralized body carry on the voting scheme, and what comes out in that is that normally policies where everybody agrees on get implemented, and where there's a disagreement, such regulation tends to get watered down. So there's some sense in which there is a uniformity in implementing these things. So this is what I talked about. If you look at the economic theory of federalism, I talked about the decentralization theorem, which essentially was, in the absence of spillovers, decentralization is more efficient. And there's also an organizational economics literature I was referring to that talks about this. So there's sort of a big literature about the trade-offs. Benefits being better information, better allocation decisions, better allocation of resources, better decisions. The flip side being opens up to capture and corruption. And so, what's the optimal level is an interesting question. Of course, I've also mentioned that centralization is better at managing externalities, economies of scale, and solving coordination problems. Now, the paper I'm going to present actually fits in more. So, if you look at the first wave of literature on centralization, decentralization, this was this Oates literature, Thybaut, Oates, etc. Right? The discussion there was more about externalities and how do we solve coordination problems and how do we get to better outcomes. Right? The second wave of literature actually talks about incentives of officials. Okay, that's sort of the different thing. So, because the first wave of literature was focusing more on developed countries and the problems of developing countries, where people understood that the institutions are properly in place, these were the discussions that were happening. But now there's a growing recognition that even this stuff of incentives of government officials, etc., are important, and corruption is no longer a developing world phenomena, but is also quite rampant in developing countries. That this one has taken the second wave, or the second approach has now gathered some momentum, and this is what this paper is going to be looking at, which is this presentation is going to be focusing on, which is fitting with this. So this paper fits squarely within the second wave literature on decentralization, which focuses on accountability and incentives of government officials and politicians, in contrast to the traditional literature on fiscal federalism, which stress the role of preference heterogeneity for public goods and interjurisdictional externalities. All right. So there's not much evidence on this topic. A lot of theory here, as opposed to the first presentation that I made in general, where there is, of course, theory on regulation, but at least in bank regulation, there's a lot of work to be done. Here, I think there's a lot of theory with little empirical evidence. So I thought that maybe the empirical stuff could play a catch-up out here and then feed back a bit on the theory side of it. But the idea is to say what could be the political drivers or the political economy of decentralization out here. Okay. Now, empirically, and this will get a bit more empirical than earlier. Whenever you're looking at a question of centralization versus decentralization and trying to look at this question or examining the causal effect of that, this is problematic on several dimensions. Okay, so first, and that's actually limited research in this area. That's why there's a lot of theory on it and less empirical work on it, which is that organizational design variables, on centralization, decentralization tend to be rather sticky. They don't change a lot, which means a lot of inference that we get is by looking at, centralized structures and comparing them with decentralized structures. Okay. With such comparison, you often worry about, omitted variables, because this is a cross-sectional comparisons. Things that differ on their organizational structure differ on so many other dimensions, and that creates this issue of lack of counterfactuals. So this is going to be a political. This is going to be a slightly different swing on this. You had a question? Okay. So this is going to be looking at this distress events out here. So we're going to be looking at bailouts now. So we're going to have another institutional feature, which is bank bailouts, and these are German savings banks, okay, known as the Sparkassens, and there is a mandate in Germany which is that savings banks or banks are not allowed to fail. So whenever the bank goes into distress, there are mechanisms in place which ensures that the banks are always bailed out, which means if they're in distress, then capital is injected in some way so that the distress can be avoided. All right. Now, these savings banks in Germany are quite local. So I'm just giving you a bit of institutional detail before we get into the economics of it. They're very local. So each county has its own savings bank, and they sort of locally lend. Okay, these are state-owned, and the mayor of this county essentially is the head of the supervisory board of this Sparkassen. Okay, when a bank is distressed, there are sort of two mechanisms at work. Okay. There is a statewide, there's an association that has been created at the state level, which injects money or does some sort of reorganization when a bank is in distress. But there's also a choice that the mayor can intervene. So the mayor of the county can intervene and bail out the bank that is in distress. All right. So what I'm going to do out here is I'm going to present some stuff on what happens. So you're going to compare these two different technologies. So you're going to have banks that are in distress. In one case, you're going to have politicians bail these banks out, and the other case, you're going to have the association coming and bailing it, association being the more centralized one, and the politician being at the local level. And we're going to try and see how does the distress resolve in these, what's the resolution of distress under these two different technologies. So in both cases, so this one comes from taxpayers' money. This is the county has its, the tax revenue, and the association lends, and then they have a contract at which it has to be paid. So essentially the county does pay back this money. So it's not free money as such. In both cases it is taxpayers' money. What I don't know, and this is an interesting question, are the contract terms same, meaning the duration at which it has to be paid, etc. And I'm trying to learn that, but it's borrowing in both scenarios. All right. So we're going to look. Yes.
Is there any mechanism for punishing the managers of savings banks that have to be bailed out?
So there are political mechanisms in place because it's the mayor who's sort of the head of the savings bank, and I'll talk a bit about that, which is what it means for their re-election. I mean, I won't have much on re-election, but I'll interact this with the political cycle so that you'll get to see maybe some of that.
There seems to be a conflict of interest, though, if the mayor is also the one who is doing bailout.
That's right. No, so that's the question, which is that is there a conflict of interest or not? There could be a conflict of interest, and that's what we're going to try and see. Now, so let me just, what I'm going to show you some data on what happens when, how is distress resolved when it's bailed out by the mayor versus the association. By the way, association is also a political body of mayors of different counties, and there's a rotation policy through which they get elected. And so I'll be comparing the two technologies to say, first of all, is there a difference between the two in which they carry out these bailouts? And the second thing is going to try and say something about which one tends to be better. So remember earlier I talked about this centralized structure being very difficult but hard to tell which one is better or which one is worse, except that there seems to be a tough. Here we'll try and say something on what are the economic impacts of that. So what you can look at are county level variables of what happened after restructuring, how was credit given out in that county after the restructuring, and what that generated for county level growth, etc. All right, so we're going to try and I'm going to try and give you some data which will trace out this effect. Now, whenever someone says, let's look at bailout by politician versus bailout by the association, the obvious question that comes to mind is that perhaps the banks that are bailed out by the politicians are very different from the banks that are bailed out by the association. So how can one compare technologies if the unit on which we're examining these are different itself, right? So we need somehow a way to compare similar banks so that we can actually evaluate whether there's something different about these two different technologies. Otherwise, if the object of that is being treated is different, then that makes it difficult for causal inference. Okay, so just to give you an organizational structure of the bailout institutions, and I'll try and simplify it. These are the different banks that are operating. These are at the county level, locally operating. These are state-owned banks. There's a politician in that county. So this is a bank in A1. This is a politician in the county who sort of controls the bank. And there's an association, which is basically all the counties in a given state. There's an association that is representing them, which is in place. And then there's also an association at the national level. And the idea is that if for some reason defaults tend to be correlated and there's not enough money available out here, they can always go to the national association and get bailed out. All right? Yes? Oh, you just, okay. No, I just thought you had your hand up. Okay. So that's essentially the structure out here. Okay. So what I'll do is I'll present some results, to see how the electoral cycle, so these mayors who are in charge of these saving banks, right? How does their decision to bail out a distressed bank vary with the electoral cycle? All right, and that'll try and give us some indication of whether this is popular with them, whether this is, this will give us some idea of how the electorate perceives this decision. And in second part, I'm going to present some results on how can we evaluate these actions of these two different bodies, which is mayor versus this. And here, what is going to be done is, there's this electoral cycle is going to be used to randomize in some sense or to generate an instrument on who treats the bank. So the bank is in distress, and then you're going to be discussing actually what's the decision being taken, which is the party that is going to be looking at it. So just to give you an intuitive sense of what's happening out here is that what we ideally want is there's a bank in distress, and we want to see who treats the bank, and this could be a politician. We want to track what happened to this bank. Then we want a counterfactual that what would have happened if the same bank got treated by the association, what would have happened? And by looking at the difference between the two, we can say this is a difference in the technology, right? Now, you don't have this where the same bank is treated by the two things. What you, however, have is that, so imagine that we have about 150 banks out here. If you remember this 48 number that I was getting confused with, there are 148 distressed banks in Germany. These are banks that have undergone distress, all right? And if you look at the distress and you line it along the electoral cycle, which means -1 being the year before the election, -2 2 years before the election, +1 1 year after, and so on, you see that the distress is sort of uniform. There's a slight blip, and I'll talk about it, but the distress event is sort of uniform, is pretty uniform across the electoral cycle. So roughly you'll have 30 banks distressing if there are 150 banks. Is that clear? And the reason is that the supervisory authority is the BaFin, which sits at the national level. Now, what you see is that if, on the other hand, you look at who bails out the bank, you find that the politician is very reluctant to bail out a bank if distress happens the year before the election. Okay? So what you see is that while distress does not have an electoral cycle to it, the decision of the mayor to intervene and bail out a local bank, to bail out a savings bank, is significantly lower the year before the election. All right? So that already tells us there is something that by bailing out a bank, that bailing out a bank in distress perhaps would convey something negative perhaps to the electorate, and I'm going to show you that. Once I've shown you the electoral cycle, yes. So the automatic this thing is the association. The association is always going to be informed as soon as the distress happens to the authority. But the mayor can intervene and inject the taxpayer money and avoid that association from doing it. So if the mayor doesn't do anything, associate. Sorry?
You don't have already like some banks that you know they are going to be bailout by politicians or by associations?
No, we don't. I mean, I'm sure there are some characteristics of banks which can be used to predict it. For example, you could think that if a county is indebted, and we have such a result out here, that if the county already has a tough fiscal indebtedness, then the likelihood of them bailing out is very small. Okay, so there are some predictors of that. I'll show you some of that stuff. All right. So first would be just to show that distress has no cycle to it or less of a cycle, but there's an electoral cycle associated with this decision to bail out by the politician. Once you establish that, we're going to use this to come up with this counterfactual that I was telling you earlier. And the idea behind the counterfactual would be the following. All right. So just if you give me your attention for just 30 seconds, focus, and then everything will be clear. So imagine that there are these 30 banks that are getting distress -2, -1, and so on and so forth, the 5-year electoral cycle. All right. I'm going to show you that these banks are very similar and the distress does not have a cycle to it. All right. The 30 banks that are bailed out just before the election are all going to be treated. In the extreme case, I'm just making it up, it's not really like that. Let's say in the extreme case, all of these are bailed out by the association. All right. If this distress happens the year after the election, these 30 banks are now going to be bailed out by the politician to a higher degree. If I compare the 30 banks after with the 30 banks before, not knowing anything, saying that these are identical, what I'm getting from the electoral cycle is a difference in the probability at which they're being treated by the association versus by the politician. If I follow these 30 banks, that will give me from the electoral cycle a way of seeing how this treatment affects how this treatment affects the outcomes. Does it make sense? So I have the same 30 banks, and I'm going to try and show you that they're the same 30 banks. In some cases, they're going to be treated by the politician, which is going to be the year after the election. All right, and there's going to be very little intervention the year before the election, and that difference between the two is going to give me whether this technology is different. Once we can see that the technology is different, we're going to try and evaluate on dimensions, which one is better. All right, and that's essentially where we're going with it. Okay, so the idea behind this, so this is a form of randomization that we're getting from a slightly different approach rather than the treatment control that we talked about. Okay, so yes. That's what we're going to try and figure out. That's why it's political economy. So there's some, what we'll get out here is that there is some private benefits to the politician, perhaps coming from the fact that controlling of a bank might allow them to, lend to certain, voters or whatever before the election. Or, there's some private benefits of controlling the bank, and I don't want to lose control of the bank. So let me show you what they do first, so that you can understand what are the incentives of the local politicians to go ahead.
Just a clarificatory question. Is there an option for the bank to declare declare distress after the election? Can they delay declaring?
Yeah, so there is, which is why I wanted to show you that distress cannot be manipulated that much. That's why I said distress doesn't happen. Okay, and we can talk about what if that happens. What would be the issue with such a thing? So if you look at, for example, what this is doing is, You have this pool pre-election that I was telling you earlier. There's a pool post the election, all right. Some of them will always, you can think of some of them were bailed out by the association before, will bailed out by the association afterwards. Some were bailed by a politician before, will bail out by a politician afterwards. And then you have a group of guys who would switch. And it's these switches which are being used to identify this effect effectively. Is that clear? But we don't know which those switches are. We're going to compare the entire 30 here with the entire 30 here and trying to say something about the entire pool and what this implies for the inference. Okay. So just to give you a set of results, what you find, as I said earlier, the intervention by the mayor follows an electoral cycle. All right. So the occurrence of distress does not depend on it statistically, but if the distress happens to be before the election year, then the politician bailout is 30% lower. And what you find is that whenever the politician does a bailout, this is associated with worse long-run performance of these affected banks as measured by some health ratios of these banks. So the banks that actually emerge tend to be less, and there's a higher instance of redefault. What you also see is that when the politician, I should have said this earlier, BLP here, by the way, refers to bailout by politician, and BLA is bailout by association. I don't know why this is created like that, but I'd like to blame my co-authors for it since I'm recorded out here. Anyhow, so what you find is that one thing that you get out here is that when the association does as a bailout, consistent with some of the other studies, you find that the association is much tougher on the savings banks. And what it does is that when it resolves distress, the resulting bank is much smaller, so they close a lot of branches. And in many cases, there's something called a distress merger, which is they merge this bank with a neighboring county. That means that the county itself loses the bank, which means mayor has no control of the bank. So when the association does the bailout, two things happen. Either the mayor is in charge of a smaller bank because the other branches have been closed down, or the mayor has no bank at all because there has been a distress merger with the neighboring county. On the other hand, when the mayor does a bailout, what you find is that the bank remains roughly the same size. It keeps operating in the same way, but the health ratio of the banks are lower. Okay. Now, when the association does a bailout, the health, some ratios of bank health, which I'll talk about, like some profitability measures and liquidity measures, some measures that we relate with as the health of a bank. So banks are healthier in bailout by the association. Okay. Now, when the association does a bailout, I already said that the savings bank is either smaller, right, and in many cases it even belongs to the neighboring county. What you see is that you see an instant drop in the state supply of credit in that county because savings banks are supplying the state financing. But what is very interesting is that the private actors come in and fill the gap very quickly. So what you don't see is a drop in the overall credit going to the county. What you see is a drop in the share of private versus state financing in a given county. All right. So that's how it's yes, Eric.
So if we accept these results, then the obvious question is, why does the association allow mayors to bail out banks? Why don't they insist on being in control themselves?
Why is it not always centralized? I guess that every time the mayors probably are intervening, they're probably doing it on this context that they have better information and the restructuring.
But this says that they don't.
Yeah, so association doesn't have a say in that. They should be probably allowed to say in that.
The association cannot overrule the mayor?
No. They cannot. It's like a backstop if you want to use it, but if you want to use your own taxpayers' money, you always have that option of doing so. But you're talking about a more general policy, which is why don't we just not allow the mayor to bail out? Yeah. Any German out here? How big are these counties in terms of population? I asked this question for two reasons, because there's no German I can make up any story.
Companies don't really do that.
But if they are, then I can just pre-write on them rather than give you a wrong number. Please go ahead. That's a safe answer. Very heterogeneous. That will always be a right answer. So 35,000. My sense was 100,000 is the average size. Is that fair? Cologne is probably an outlier, no? It's not even a county, it's something. Yeah, exactly. That's what I remember.
But that speaks to the relation between the mayor and the association. It's small it is because of the relation between them.
Between the mayor and the association.
Yeah, the smaller the set of counties controlled by the association.
The set of counties, yeah. So you meant how many counties are there in a state?
But that's too, but it's also a matter of people. How big is the county and how many counties there are? Yes, this whole structure is relevant.
So I think for each, so I think for each state you probably have about 11, 430, about 40 counties on average per state. So I don't know whether that's enough for a cozy relationship or not, but yeah. But I don't think it really, yeah. It doesn't come out. We looked at whether, I'll show you something. It doesn't tend to matter that much. Yes. Yeah. So let me go through this, and then we'll talk about all sorts of issues that the selection type of issues that might. I totally, there's a host of things that I have to first show you for me to. So if you just hold on to that. Was there another question somewhere? Okay. So yeah. Also, what happens is that when the association does a bailout, you see much higher corporate sector growth. You see some evidence of less creative destruction. More creative destruction, which means association is tougher. They liquidate more firms enter. And overall, if you look at the economy-wide parameters such as GDP and employment levels, the association bailout tends to do better on those dimensions. If you look at what happens 5 years later in that particular county where the association does a bailout, not only are the banks better, but also the county is better on certain dimensions such as income levels, GDP levels, employment levels, and things like that. Okay, I'm going to skip this stuff. So I'm going to the data here will be from 1995 to 2010, and again I'm going to use the Bundesbank data. They have given us which banks were distressed, and they also tell us who bailed out the banks, whether it was a politician that bailed out and the association that bailed out. Here's a summary. I'm just going to not present everything because it'll get very boring very quickly for you all. But I'll give you the summary of this. So this is about 148 banks that are under distress. As you can see out here, 55 banks are bailed out by the politician, and the rest 93 are bailed out by the association. Of the 93 that are bailed out by the association, 49 had a direct capital support and restructuring that I mentioned, which was smaller banks, and 44 were involved in a distressed merger, which meant that the county in roughly 50% of the cases lost the control of the bank altogether. All right, so whenever the association does it, either you have a injection but a smaller bank, and in this case there's a distressed merger. Okay, the size of the bank is given out here so that you can see, so these are the total assets of the bank. The size of the capital injection is about 11 million. The local GDP is about 4.8 trillion. The total tax revenue, local tax revenue is about, these are averages figure, about 160 million. So the size of the capital injection is quite sizable if you think about it from a county's perspective. All right. This is just showing you what happens in terms of when the association does it. They just the central message out here is there's more restructuring happening under BLA. So if you look at employment level at the bank goes down. If you look at number of branches, they close down more. So there seems to be more, the banks that emerges is actually going to be, is smaller. So decline in customer loans, employees and branches, all right. So here are the few graphs, because I think graphs are always easier to sort of understand the whole picture. So this is plotting distress along the electoral cycle, all right. So this is 0 to 12 after, 0 to 12 months before. And what you see out here is that there is a slight dip, you can think about it, but it's roughly, it's not statistically significant. This is how distress happens along the electoral cycle. Is that clear? If you now look at what happens to the bailout by the politician, okay, there are these odd 4 cases, and I can tell you more about these cases, these are special. But there seems to be very little bailout before the election. In fact, we now have data on at a 6-month frequency, and you can see that there's actually 0 bailout 6 months before. The politician doesn't touch a bank like that. So the more fast, closer you get, there is this stuff. Okay, so the message that I'm trying to, play out here, and we'll talk about selection concerns a bit, is that there seems to be a flat level out here as far as distress events are concerned, but bailouts by the politicians seems to follow the electoral cycle. And then what we're going to do is we're going to use this to somehow see whether they do something different. Okay, any questions on any questions? Okay, I'll come to your selection issues in just a bit. There are a lot of selection issues, so this is not as clean. I'm not claiming it at all. All right, so what this is just showing you is that, I'm in the summary slide, it just mentioned that there's a 30% lower probability of bailout if the distress happens the year before the election. And this is what you get out here, statistically significant. This is where the number came from. So you're just looking at conditional on distress, who's bailing out, whether it's the politician or whether it's the association, and it says the politician bailout is 30% less likely. And then what you're going to do in the part 2 of the paper, having established the electoral cycle, you're going to use this as an instrument. But the idea of the instrument is already given to you, which is I'll take the 30 banks before, 30 banks after, and what I'm going to show you are results on what happens to these banks going forward. All right. Now, okay, what comes out, because I actually don't want to get into the too much of the econometrics of this whole thing, right? But when you run a regression and you're trying to, intuitively, let's think about this. When I run a simple OLS regression, and I'm trying to say, let's look at bailout by the politician versus bailout by the associate. What is the real concern out here for us, going back to selection? The concern is that if I show you that association does a better job, right? The concern might be that association is not doing a better job. Association is handling easier banks, let's put it this way. And so the fact that they're coming out better is because there was not much required out there. But politicians are having more complex cases. Is that clear? And therefore, they're not doing anything worse than the association. Had they got the same banks as the association, they would have done a similar job, similar task. Is that clear? So if you run a plain OLS, this is the concern. All right. So if banks were randomly given to the association versus the politician, you would be fine. Also, if the politician were getting easy banks and the association was getting complex banks, you would still be fine, even though there would be a bias in your estimation. The bias would be in your favor, because you would establish the fact that the association is getting complex banks and is still doing much better with those banks to some extent. All right. So this is what randomization allows us to get to. So what I'm going to show you is what happens when you run a pure OLS regression, which is not accounting for the selection effects, and then what happens if you do randomize it using this electoral cycle. All right. And if you get the randomized results stronger, then it tells you something about the selection that might be going in place. Does that make sense? That's the whole idea of this thing. And what you see out here is that, this use of instrument or IV in the setup is nothing but a way of randomizing things. Okay. So what, you can run, as I said earlier, you can run a simple OLS regression where you can have a variable which is the bailout going to happen by the politician, or is it going to and look at it? And this is just telling you that, you could have biases if epsilons and the x's tend to be correlated, which is a way of saying there is an omitted variable that is driving it, and the IV takes care of that stuff. Okay, so I'm going to skip all that, and I'm going to just give you the summary of the finding, and then I'm going to move to the other part. So first here is that you need to establish in this analysis is that along the electoral cycle, and this is your point earlier, that the banks are pretty similar. Okay. Now you cannot say this on unobservable because you don't have the data. So what you do is you show whatever data you have on the observable dimensions, these banks are actually similar. Because if these banks are similar, then you can say that, you know what, these 30 banks before distress are similar to the 30 banks after distress, and by looking at the difference between these two banks, you can say something. All right. This is first of all just showing you statistically that the distress chart is not statistically significant. Here's a bunch of variables that you can look at the bank out here. So this is total assets, number of employees, number of branches, and these are just averages reported, and you can also plot their kernel densities to look at the entire distribution. But all this is telling you is that there seems to be no difference in the average banks that were before and the rest, all right, at least on hard characteristics. Okay, this still doesn't take care of your issue maybe of something on the softer dimension, but all this is doing is it's saying, are these banks looking similar, or is there some sort of other manipulation happening which creates a problem? So this is just establishing that bank characteristics are similar. This is also telling you that the capital injection is quite similar between the association and the county. So it's not that the size of the bailout or something on average is different. This is looking at what happens to local macro conditions along the electoral cycle. All right. And what you find is that, you know, if you look at the local macro condition before and after, there doesn't seem to be pre-elect and post-elect, you know, differences in county, etc. So basically, the idea is that there seems to be no systematic differences in at least observable dimensions. Okay. Now what happens is you look at the performance of these banks, and you're going to do this at different levels. So this is looking at 5-year after bailout events, what is happening. And what you can see out here is, there's nothing controlled for. This is NPL here refers to the non-performing loans. Okay, this is a measure of the bank's health. Okay, what you can see out here is that the difference between BLA and BLP is lower. Seems like what this is saying is that the banks that are emerging, the banks that are bailed out by the association, tend to have lower non-performing loans. If you look at loan loss provisions, which is another way of looking at the health of the bank, this is what I meant by the health of the bank, you find that the banks tend to be healthier under BLA. You can look at the capital ratios. These are just some measures of bank health. These are some measures of bank profitability. But all these dimensions, the message that is coming out on this slide is that the banks that are emerging from distress seem to be better when the association does a bailout than the politician does a bailout. You can look at what happens to the share of financing. So this is the banks are healthier. What happens to the share of financing? As I said earlier, if you look at the ratio of the financing in a county, if you look dividers between state financing and private financing, you find that state financing shrinks, but this doesn't lead to a drop in credit, all right, because the private financing comes in and makes up for that. So what changes at the local level is the mix between state financing and the private financing, but the overall amount of credit seems to remain the same. Okay. Now, what is the mechanism through which, you know, what else is happening? What you find is that when the association does a bailout, there seems to be, you know, more new relationships being created and a lot of old relationships being terminated. All right. So somehow savings banks tend to be slow. Okay, call it a soft budget constraint or whatever, that once there's a default, they tend to continue too much. This is the last two tables I'm going to probably show. I can see a lot of eyes closing already. So this is looking at how does bank change their behavior when the association has bailed them out, and possibly also governing some things about how they're allocating resources. So this is basically a measure of, are they changing the behavior? So you're looking at a savings bank that has been bailed out by the association, and you're comparing it to a savings bank that has been bailed out by the politician, and you're looking at how are they allocating credit differentially across across the different county. All right, and what you find here is that when the association does a bailout, the bank seems more responsive to what is called the marginal product of capital, which means, the way we think about what is better allocation of resources is that those that have higher marginal product of capital should get financing, and those have lower should not. So it seems like when the association does a bailout, there seems to be a change in how credit gets allocated in the economy. And finally, what you find is that there seems to be a drop in preferential lending or in group lending. So there's a data set out here which links the mayor of the county to his in-group friends and stuff like that, and you find that there seems to be a drop in preferential lending that comes about it. All right, these are just some variables that are showing that the county is actually doing much better under the association. The corporate, health, the corporate sector is thriving. The employment numbers look much better, and then if you look at just some gross measures of macroeconomic performance, what you find is that the county looks much better under the associations. If you look at employment numbers or something else, it seems like this has long-term effects, positive long-term effects for the county. All right. So this is essentially what you're getting out here is that, just to summarize the set of results, what you're getting out here is, so what we're doing with this study is trying to compare these two structures. All right, bailout by the politician versus bailout by the mayor. Clearly, they're different. Okay, because it's coming out. And what then is being done is tracing out what exactly is being done different. All right, and what you get out here is that bailout under the politician seems to be, one of the reasons, and this is quite telling even from the electoral cycle. If you remember that the electoral cycle told us that the politician is less involved in bailing out a bank, that already tells us that perhaps that bailout of the bank would be less popular. Why? Perhaps that money could have been spent somewhere else instead, and that lack of that generates it, and you see some of these effects on that as well. Now, what according to me was interesting was that there is some literature that has documented, and there's literature on India as well, that when you sort of decentralize decision making, okay, so that decentralization of decision making tends to be a good thing. But this effect gets muted in, so this is a paper looking at decentralization of bank branches in India and how they're allocating the resources. So it comes out is that decentralization tends to be a good thing in many situations, but if you have corrupt environments, then centralizing decision making is the right thing to do. All right. Now I don't know what is it about. So is this centralization thing very specific to the banking industry, which somehow resembles some sort of a corrupt environment, or there's some private benefits of control with this industry? That's to be done. But what is really coming out is that there seems to be some private benefits, or the political economy, what is called as the political economy of decentralization, which is mayors want to control the bank, and that is preventing. That is what is driving some of these decisions. Okay. Yes.
Just simply bailing out the banks from the point of view of the mayor, do we have evidence that it increases the benefits or the control of the mayor on the bank activity, or it's just a way to actually preserve what he already had?
So bailing out by the mayor, does it preserve?
Preserve, or rather increase the control of the mayor on the bank?
Definitely preserves and increases the control if the mayor does the bailout, and that's the reason why the mayor does that bailout. But it's not a good thing from a county perspective. So it doesn't seem to be, the reason for the bailout doesn't seem to be what people think about decentralization by the mayor, which is mayor might be injecting because let's say the association is going to do something which is going to be negative for the county. Mayor has better information by controlling the bank as opposed to association interfering with it. The benign view would be the mayor would generate good things, it would allocate projects money in the better way, more responsive to local needs. It seems like giving control of the bank to the mayor seems to be detrimental. Association, when it comes in and restructures the bank, seems to be generating greater good for the county on some dimensions. Okay, so if you look at not just, if you look at not just the health of the bank, because those variables are not easy to understand, but where, you can always have inefficient continuation or inefficient liquidations, right? But if you look at things like long-term growth parameters, employment numbers, counties where the association has bailed out and the mayor has not been involved in it seems to do slightly better on those dimensions, suggesting that mayor control is not at least doing the good things it should be doing. That's how I take this result. Yeah.
Could it also be related to the idea that the association is doing this kind of thing say, for the 20th time, the mayor is doing it for the first time, and that is more about learning how to handle this type of situation?
Yeah, so there could be things like maybe the association has better expertise, for example, not just because of doing it many times, but if you look at the association body, it has not just the mayor but mayors of other counties, and that could be one of the benefits of centralization in general that people have talked about is that you get a resource pool that might be more competent, right? And that might generate the benefits as well. But the fact that the mayor is intervening in such a thing, and it doesn't have to intervene. It should always go to the It should go to the association. What it turns out is that mayor intervention doesn't seem to be. You would have thought, mayor probably understands what the decision of the association would be, because the association is probably going to follow some rule-based way of doing it. So when they're intervening, they're doing it because they feel that the association's decision would be suboptimal or something. I don't know. Yes, Eric, and then I'll come to you. Yeah.
So I asked before why the
Associ-
system allows mayors to bail out at all, given that they do it worse than the association. But an even more fundamental question is, why are mayors on the boards of these things at all? That seems a peculiar arrangement. In other countries, there's a separation between politics and banking. Why not here too?
Yeah, but it's not quite clear. But there may be formal separation, but are they really separated in other countries? It's not obvious. I think there's a close connection even in the U.S. between the financial sector and the politicians.
Of course, but if you formalize it, there's a danger.
It's even worse.
There's an even greater danger of the two being mixed.
No, not true.
So what is the rationale for?
The county.
That's the point. The equity is not public, not private held, but by the public institutions. The equity of the Sparkassen is held by public institutions, not by individuals, not by private money, it's not private money.
But the mayor has a conflict of interest.
The whole arrangement
So,
is conflicted.
Yeah, but this is true, by the way, for most countries. I should say that wherever the state banking is involved, there is some form of interference from the politician. It's I was talking about an informal connection between, say, the Wall Street and this, but if it was state-owned finance, state banks, right? Which I don't know how it's in Israel out here, but many countries, I can definitely talk about India, and there is state banks. There's always this politicians having control of the banks, and that's the reason why they don't want to. But that's their decision. Sometimes also when you try and take the decision away from them, that's why they resist it. Which is what this is saying, is that there are some private benefits of controlling the bank, and you're right. Why do we need to have it in the first place altogether?
So what is the answer to that question in Germany?
Why is the setup like that, and why is it?
Why does that system continue?
Well, I think now, hopefully, with evidence coming out, they're going to act on it, right? It's one of those things where, till the time obvious things are reported, sometimes, right? It's like things are working fine, because there's a lot of people who would praise the virtue of state intervention and talk about how great it is and how markets are terrible and how much they, what are the bad things they do. A lot of people would say savings banks are very good in Germany, and the fact that state owns it ensures that projects don't get liquidated enough. This is good for, private banks perhaps are generating more inequality because they're targeting credit in a certain way, which is generating growth, but they're also leaving some people behind. I have no idea.
By the way, is there a regulator in Germany that could change this? Do you know?
Change the structure.
Yeah. But is there
I think this would be a political.
Is there an authority there that can simply come and say, from now on,
So the authority
doesn't intervene?
No, there is no authority that I know of, because the regulatory authority or the supervisory authority is just in charge of supervising it. Perhaps there has to be a legislation that has got to be passed at the parliament or something to say we need to change the governance of the state-owned banks in general, or privatize them. Or I don't think the regulator has this authority. Regulators, yeah. They don't have this authority, in my opinion. In Israel, are there a lot of state-owned banks? I should be knowing this, but I don't. Are there state-owned banks in Israel?
There is one,
Just one state-owned bank, okay. So the Israel, this problem is, you've already sorted this out. I mean, even the first paper that I was talking about, the complexity when I was looking at large and small banks, right? US did not allow for this model implementation because they felt this would be like that. But Europe said, no, this is how we're going to go about it. So US had a very different implementation of, so there are a lot of countries who understand these conflicts and have operated differently. So US, for example, has gone through stress testing and has not allowed for this type of a model-based approach to govern things. Yes. So if anything, the financial crisis in many countries have increased state ownership of banks rather than decreased it, right? Because they all blame the private sector for this whole thing and this. So I think this thing keeps going back and forth. People are very happy about how private banks operate till there's a crisis, and that leads to a massive bailout. That is followed by government intervention on these things. So many parts of the world post-crisis, if anything, government ownership of banks has gone up rather than gone down. So this problem that is out here has sort of gone worse. I don't have much more to say, and there's time, so I'll just stay, and if there are any questions, I'll answer. But
Any more questions?
yeah.
Is it possible that the facts that you're estimating could be differential across different states within Germany? Is it better for you to take a look at that?
That the fact that they could be differential.
Bavaria, they think their rate is, so maybe things turn out different in Europe.
Yeah, you could look into that. We'll have to have a reason of why. So it would be good to know what happens, remember, there are only 148 banks going through distress, so, which is not a small number. A lot of times people do analysis of one bank and stuff like that. But, yeah. Now, one thing that I talked about the distress not having a political cycle. It reminded me, there is a QJE paper which looks at distress of banks in many countries. And they find just the opposite result, which is that banks delay distress of banks before the election. So if there's a distress going to happen and there's an election, somehow distress gets delayed. So which was very interesting out here. And frankly, I didn't know how to think about the electoral cycle. I was actually thinking, if anything, there could be more intervention by the politician, but that's a separate.
Who reports distress here? How is distress determined?
So the bank, I should have mentioned, So the way the distress is determined, and a lot of times this happens, that a big firm in a county fails, for example. So those, the loans are not repaid, and that generates your capital now. The capital regulation that we were talking earlier, there's going to be a capital shortfall. So now you have to either deleverage, or you need to come up with some capital in order to continue. So the BaFin which is the centralized authority, is notified right away and informs the association of the bailout, and this happens within days.
So it's the regulator who notifies the association.
Yeah, it's the savings banks that notifies the centralized. BaFin is the federal agency who then communicates it to the association that there's a distress, and then they start deciding what the package is going to be. All that is done in less than a month.
There's still a choice there, it's not the government. The bank can extend the loan
Yeah.
to delay
This
the
is,
stress. So the payment
So-
of timing is
yeah, so this is what I was going to say. When you ask me about the incentives, what are the punishment schemes? So there are a couple of cases, and you will tell me the precise, because you would probably remember. I think one was in Cologne itself, where these guys are all civil servants of these savings banks, are also civil servants, and there was a case in which some fraud was determined. If for example, evergreening or some fraud is found out, then there are some career implications for these civil servants out there, and that's why they say there's less of this evergreening that happens. I haven't checked it, but there's a term used for this in finance and economics, which is evergreening of loans. The idea is that there's a default, but if you recognize the default, right, then you will have to put aside, you have to come up with capital for that. What you instead do is, if there's a shortfall, you originate another loan to the borrower. Part of that loan is used to pay back the loan, so it looks like the payment is on time, and then the bank goes to the next period, and so they can continue. Does that make sense? This is called evergreening. You're just putting it on life support just to avoid distress at a particular time period. We don't see that in the data, but this is a possible mechanism. This is what we were talking earlier as well, is optimal for the bank and suboptimal. Do you remember this discussion we had? Yeah. So that's definitely the case. The question, for example, here would be, which banks are likely to go on that? It's not obvious, but if you thought that, let's say there is a possibility of evergreening. Okay, so if I go back to this figure out here, let's say there is a possible of evergreening, and we do see a little bit of a drop out here. So maybe there are some banks that are pushed out here, and then when they're pushed out here, the politician can bail them out, because now politician doesn't have that political constraint that the politician is worried about, right? Which should of course then create some selection issues, which is that banks here are different from banks out here. Now the question is, which type of banks do we think are more likely to be pushed in that way? Let's say such a mechanism is possible, right? One is that a bank is in deep this thing. That means I'll have to evergreen a lot of stuff in order for a bank to be pushed on that side, right? So if you think that there's going to be some good banks and bad banks here, and good banks and bad banks out here, and of these good bad banks, some of the less bad banks can be pushed out here. Does that make sense? Then you would get even a stronger result in some sense, right? So in that sense, you're okay with that type of a selection effect, which is a bit similar in spirit to what you were asking earlier.
Or alternatively, banks which have good ties with the politician. There's some sort of collusion. Let's keep the bad news till after the election. Then after the election,
That's. But this is what I'm trying to say, that there has to be some. Yeah, but if you have good ties with the politician, then it has to be correlated, the ties with the politician, because politician already has incentives to keep the bank, right? It is the bank of the politician in some sense. The politician is so.
But it's potentially embarrassing to actually bail it out before the election. I mean, it's a tough sell.
No, all I'm saying is that it's fine. That's the reason why the politician is not bailing it out. The question is, which of the banks are being pushed to the next spot and which are not, right? So I'm saying that in the extreme case, I think I want to believe the story that the politician really wants to bail out the bank and wants to control the bank, But because of this political constraint, or maybe another constraint, which is if I put in this money in the bank, I will not be able to spend this money on my election campaign or whatever it is, which might increase my probability of getting re-elected. So there's an alternate source of it. All that is fine. Yes. Okay. Yeah. Okay. Israel is very good in that sense that they've recognized the issue. I mean, issues of state intervention. If you talk to Germany, they actually extol virtues of state intervention, right? I mean, they want. Yeah. I mean, right now perhaps they want to move towards a market, right? If you, for example, in Brexit, you always hear that if anything, France, of course, wants UK to leave, but Germany doesn't want to because Germany wants to move to the market-oriented system but doesn't know how to do it, and they think that UK perhaps will give that balancing act. With France and Germany left, it's going to be more state and more, but I still think that Germany is very state-driven still. But again, this is my, so Israel is different in that sense. Yes.
I'm wondering, is there these are the really only two ways to bail out a bank? There is no case of bailing out by even more central authorities, say?
So we do have there is a mechanism. It has never been exercised in the data, which was there was a national level association. I went through it very quickly, but if you remember the organizational chart, there is an association at the national level as well, and that the reason for having a national level association is that if they are correlated defaults, which doesn't happen, I mean, you can see the defaults are quite spread out, they're not, then maybe the association won't have enough money, in which case you could borrow from the national association.
Because in theory you could think also that instead of being the politician having like private incentives, it's rather that he has a more restricted view, and so while the bank association is considering more things, like also has a wider view, and this is why in the end ex post its solution results could be better in a way.
Yeah.
That was
That bank has,
like in a sense the mayor is only considering his own county, while the bank association is also considering what is the feedback that would have I don't know,
yeah, I would,
other
but
countries or-
okay, so I would argue that if the association is already doing a better job with this stuff, right? I'm saying this is absence any discussion of spillovers and things like that. But suppose these bank thing also had spillovers on other counties, etc., the bank distress, right? Then you would think that it's even a stronger case for centralization. Does that make sense? Like, this is absence all that, right? This is just saying is that these two guys are doing and this guy is doing a better job. But if you say now, right, the arguments for centralization, for example, is also that the centralized structure is better because it can also take externalities into account. Then I'm saying is that would even it'll make a stronger case that we should separate these, we should centralize it, let's put it this way. In that sense.
Okay.
All right,
Thank you very much.
thanks a lot. And
Well, in both these papers, you got some really compelling results. I hope they have an effect on policy.
well, let's yeah.
We'll see. But,
Yeah, absolutely.
but
The
really
first one has had some changes.
Has it? Good.
Yeah. They've changed the regulation a bit on that. This one is a bit more.
Have you been in touch with authorities? In
Yes.
Germany about this?
Yeah, the first one, the new European regulation and also the US regulation has taken and have amended that. Also, the German authorities have been, the second one as well, but yeah. Couldn't think of other topics to.
They were private, all of them were private and were national. I was wrong. All the banks were private,
Okay.
and there was a collapse
all the banks collapsed,
Yeah.
and the state nationalized all the banks in '83.
Is that right? Okay.
Yeah, yeah, that's for sure. And some of them went to jail, the head of banks, but there was one who escaped prison. There is a legal abuse of forces was a legal term that was implemented. The mistake is recorded.
I see.
So for me too, I mean, obviously the biggest county will be Berlin, right? I mean,
True.
I'm pretty sure Cologne, Bonn, they have the biggest balance sheet. So I thought of big.
Yeah,
and
they
then
have in some places they have. So normally these banks are at the county, but because I have some German courses, they told me there's also
Yeah.
some cities which are bigger than the county. So and then you
Yeah.
have it at the city level.
I'm not sure. So and then Cologne, Bonn, Paul was right, it would be like 1.5 million. So I mean, in the end,